is Friedman and Schwartz and the financial crisis of 2008. And talk about how Friedman and Schwartz saved the world in 2008. This is it's a little bit of an exaggeration. So Milton Friedman was a Chicago economist. He was born in 1912, died in 2006. Anna Schwartz was an NBER economist, born in 1915, died in 2012. So by 2008, they were either gone or well retired. And together they wrote A Monetary History of the US, which was published in 1963. So I exaggerate to say that Friedman and Schwartz saved the world in 2008, but it's only somewhat of an exaggeration because there really is truth in saying that Friedman and Schwartz, with their monetary history, they taught the Federal Reserve. They taught the Federal Reserve how to manage the 2008 financial crisis. And so what I want to talk about today is some of that monetary history, and talk specifically about 3 episodes, which teach us about money, banking, and liquidity crises. The first one is 1907 to 08, the liquidity crisis in the US, centered in New York, which restricted convertibility and was an economic depression. And then the 1930s, which was the Great Depression, worldwide Great Depression, and how the Federal Reserve failed in their responsibility to back up and save the banking system. And then turning to 2008, learning how the Federal Reserve, having learned the lessons from the 1930s, and particularly learned the lessons from Friedman and Schwartz monetary history, how the quantitative easing in 2008 really did save the financial system. So before turning to that monetary history, I want to review just a little bit Milton Friedman and his contributions to economics. I want to focus on Milton Friedman's economics. There's many histories of economics. People talk about Chicago economics. University of Chicago is renowned for its economics. But many histories of Chicago economics discuss the people and the politics and the ideology, and particularly Friedman, who's the best known of the economists from Chicago. But I really want to focus on Friedman's economics, the ideas and the concepts. And I think there's 2 central themes of Chicago and Chicago economics. The first one is taking economics seriously. Taking economics seriously is a way to understand the world, the way to understand and learn about human behavior. And the second is applying and testing economics empirically. And there's this quote here from Milton Friedman, which I think really nicely summarizes the approach, the ideal approach of economics at Chicago. And it says that in discussions of economic science, Chicago stands for an approach that takes seriously the use of economic theory as a tool for analyzing a wide range of concrete problems, that insists on the empirical testing of theoretical generalizations and that rejects alike facts without theory and theory without facts. Just a little bit about Milton Friedman's contributions to economics. He contributed to statistics. It's largely forgotten in sort of talking about Friedman's contributions, but he developed the Friedman test, which is a non-parametric test for repeated ranks. His work on the consumption function and permanent income. It's a central question in terms of fiscal stimulus, as relevant today as it was in the 1950s. And this idea of permanent income is still used in economics today. Ideas of methodology. How do we as economists make and test theories? These are really fundamental and deep questions about the philosophy of science. The Phillips curve, natural rate of unemployment, and the idea of a trade-off between inflation and unemployment. And Friedman's argument that there is no trade-off between inflation and unemployment. That leads to the non-accelerating inflation rate of unemployment. This is basic microeconomics. And then monetary theory, what we're going to talk about, what I want to talk about today. And it's maybe what Friedman is best remembered for. But I want to emphasize that all of these contributions are primarily in macroeconomics. But everything he did was built on microeconomics, was built on Chicago price theory, the application of microeconomics to real problems. And Chicago really has a long tradition of using and teaching price theory. So Jacob Viner taught Econ 301 in the 1920s through 1946. Friedman taught it for many years after Viner. Econ 301 is still the core course for graduate students at the University of Chicago. And it's passed from one generation to the next. So Viner taught Friedman, Friedman taught Becker, Becker taught me, and I teach the Harris Micro 1 students. So let's turn and talk about monetary history and 3 financial crises. First of all, I want to emphasize that financial crises really are as American as apple pie. And all of that I'm talking about today is based on a course that I teach at Harris, History of Financial Crises. And I say that we will examine financial and economic history using episodes of crisis to learn about government debt, to learn about money and banking. And a better title for the course, rather than History of Financial Crises, is Money, Banking, and the History of Financial Crises. Because financial crises are largely banking crises. I talk about the South Sea Bubble, talk about Alexander Hamilton, and then talk about what I want to cover today, U.S. banking crises from 1907, 1930s, and the 2008 financial crisis. So, the U.S. and banking crises. The U.S. has always been subject to banking crises. So this is a table which sort of lists banking crises from the 1840s to the present. And various different authors, Kindleberger, a textbook that I love, Calomares and Haber, Friedman and Schwartz, they list various different episodes and crises. But let's look and focus on Calomares and Haber. So if we look from 1840 to the present and count them up, there are 12, according to Calomares and Haber, 12 crises. Some of these we know really well, the 1930s Great Depression, the 2008 financial crisis. The 1980s was actually a really, really serious in the US savings and loan crisis. But the point is, there are 12 banking crises, okay? And these involved multiple bank failures. So there were 9,000 banks that failed during the 1930s. There were 3,000 banks that failed during the 1980s. Okay, these things happened regularly during the 1800s into the 1900s. Now, by 2008, by the time the 2008 crisis happened, we had forgotten how regular these were. And so 2008 came as a real shock, but it's nothing unusual. The US just has this history of repeated banking crises. Now, here's an interesting question, and a really important question. If the US had 12 crises from 1840 to the present, how many in Canada? How many banking crises, systemic banking crises in Canada with multiple banks failing? Okay, we had 12 in the US. Anybody want to take a guess? Put it into chat. Any guesses on how many there were in Canada? Anybody have any guesses on how many in Canada? If there were 12 in the US, and remember, Canada and the US are really very similar. They share a long border. The industry is very much the same. The population, the culture is very much the same. So, the natural thing to think would be, well, if there were 12 in the US, then there's going to be a large number in Canada. In fact, okay, there's zero. Zero in Canada. There are no severe crises in terms of failure of multiple banks since 1840. And this really raises a fundamental question of why is the US so different than Canada? What is it that makes the US and Canada different, where the US has these repeated banking crises? And I think it really is necessary to look back at the history and understand the history to understand this big difference between the US and Canada. Anyway, this question takes us to the basics of money and banking. And I think really looking at these financial crises and thinking about monetary history is, number one, it's the way to learn about money and banking. And number two, learning about money and banking answers the questions. It teaches us about why do these crises occur? What is it that leads to crises, and what is it that we can do to potentially mitigate or stop these crises? So let's just talk for a minute about the basics of money and banking. We all use checking accounts. We all use bank accounts. This is a bank account where you put your money into the bank. And we use it, really, all of us use it as cash, right? People don't use pieces of paper much anymore, but 20, 30 years ago, even 10 years ago, people used cash. But bank accounts, checking accounts, is a convenient complement to cash. We treat these bank accounts like money. We put our money in, we pay our bills, we transfer, we pay our credit cards, whatever we do, we use our bank accounts, and we use that money. I even use the word I have my money in the bank. I use that as money for my day-to-day activity. But it's really important to understand that deposits, the deposits that I put in a bank, it's really a loan that you and I make to a bank. Okay? I use the term, we all use the phrase, I put my money into the bank. That's not what I do. What I'm doing is, when I say I put my money into the bank, what I'm really doing is I am making a loan to the bank. Okay? And like any loan, like any promise, that promise may be broken. Like any loan, that loan possibly may not be repaid. Okay? So bank accounts, these deposits, they're really a loan that we make to the bank. But these deposits, those are loans with two very special characteristics. The first is that the bank promises to pay us back whenever we want. That's why I can use it like money, because I put that into the bank, I make my loan to the bank, and the bank promises to be able to repay me whenever I want. It's just on demand. That's why they're called demand deposits. The second characteristic is that when a bank defaults, it's first in line. The first person to get to the bank gets their money, second person gets their money, third person gets their money, but eventually, bank runs out of money and the bank doesn't pay back. So if you're first in line, you get all of your money back. If you're back of the line, you get nothing back. Okay? And these characteristics provide a big incentive for customers to run on a bank. Okay? It's what causes banking crises. As soon as customers think there's a problem with a bank, there's a huge incentive to get there very first, take your money out, and let other people lose their money. But you get there first, and you get your money out. So, in understanding why banks are so fragile and why they're subject to runs and why we have these repeated bank crises, you have to understand that bank deposits are inherently unstable. Okay? And most people argue that this makes banks and the banking system, inherently unstable and subject to runs. And to some extent, that is true, but it cannot be the fundamental reason for why the US banking system is so subject to repeated crises and the Canadian is not. Because we see that in the US, we have 12 systemic crises from the 1840s to the present, and Canada 0. And yet the banking system, in that respect, in terms of bank deposits and customers having an incentive to run on the bank and take their money out quickly. That's the same in the US and in Canada. So this fundamental issue about bank deposits being inherently unstable, that cannot be the only reason for banking crises. Okay? And we have to understand deeper, we have to look deeper and understand more carefully about the differences, for example, between the US and Canada. Okay, so there has to be something additional to make US banks uniquely unstable. And the reason is that in the 1800s, up until the 1990s, there was something in the US was organized, and we use the term unit banking. And it's hard to imagine today how crazy and stupid the US banking system was until the 1990s. There was no cross-state banking, meaning that Chase, which was a New York bank. So a New York bank, Chase could operate in New York State only, could not operate in Illinois or Indiana or California. Many states, and Illinois was included up until the 1990s, had no branching. So if there was a bank in Illinois, and First Chicago was one of the 10 biggest banks in the US in the whole country, they had one building, okay? And they could not have different buildings throughout Chicago or the state, okay? In 1914, the statistic, one statistic I have is there were 27,000 banks, and 95% of those banks had no branches. It was just one single building for the bank. And that was a population of roughly 99 million. That meant 3,600 people per bank. It's not nearly enough people to reap economies of scale to allow diversification. Canada was completely different. In 1890, so I have a slightly different date, but it gives the idea. There were 38 banks, 27,000 in the US, 38 in 1890 in Canada, 126,000 people per bank. So each bank in Canada was huge. They were large enough to absorb those kind of shocks that would occur on a daily, weekly, or monthly basis. If there was something that went wrong in a local branch, okay, then the home office could ship money, could put a box of money onto a train and ship it overnight. In the US, with only a single branch, there was no possibility for that. Okay, so the US banking system was inherently fragile. And any modest economic shock, anything which gave a shock to the US economy or the local economy or a local branch. So for example, an earthquake in San Francisco, that's what happened in 1906. And then a severe economic recession that followed in 1907, speculative bubble in copper. Any of these things, or these things taken together, could make customers nervous and want to withdraw their money. And a small local unit bank could not call on the headquarters to ship out more cash. Canada, okay, a local branch could call on headquarters and they could ship money out overnight. And so in the US, if too many customers want to withdraw, the small local bank has to shut its doors. And so this is a quote from Friedman and Schwartz book, talking about how in a unit banking system with 20,000 independent banks, okay, you're going to have something go wrong with some bank somewhere, and that could cascade. That could have a domino effect, and what could start out in a small, just one bank, could go out throughout the whole system. Okay, so how can you break this kind of vicious cycle of a bank run? And there's essentially three ways to try to make a banking system, a whole economic system, less fragile. So one, you could make banks big enough. You could make them big, and so they would be able to withstand the economic shocks and the scares. They would be able to ship cash around the country to a branch in trouble. So that would be one way. Second way would be to restrict conversion, okay? And that would be basically tell customers that they were not allowed to take their money out of the bank. They could keep their money in the bank, they could use it for paying their bills, but they could not take their money out of the bank and put it into cash. They had to keep it in the bank, and they could transfer it from one bank to another to pay bills. So this is restricted conversion. And the third way to try to break this vicious cycle would be to have someone somewhere able to lend cash. So some bank gets into trouble, okay? They have a shock and they need extra cash. Have somebody somewhere able to lend extra cash to that bank overnight, okay? Here in number one, that would be the home office. But if you don't have a home office, you're not allowing banks to be big, then maybe have someone else, okay? Now, in the 1800s, and then most of the 1900s, the US said no to number one. We're not going to allow banks to be big. Why was that decision made? It's a whole bunch of political issues. But anyway, that's the way the world was. In 1907, there was nobody available to do number three, to lend cash short term to any banks in trouble. And so the only choice was in two. Now, in my course, I go through the crisis of 1907-08 and talk about restricting conversion. Okay. I have some slides here on the liquidity crisis in 1907, but I'm not going to go over them, just we don't have enough time. But what I want to talk about is in 1913. In 1913, the Federal Reserve was founded. And this was a mechanism. This was setting up an organization, setting up the Federal Reserve as a way of lending cash to banks, not so much when they were in trouble in terms of making bad loans, but just when they needed some extra cash for very short term, a matter of a few days or a few weeks. Okay. So in December 1913, the Federal Reserve was founded, and the explicit purpose was to issue notes by discounting bank assets, lending to a bank. Okay. And this was sort of the solution number three, to set up something so that when some small bank got into trouble and needed some cash overnight, there would be somebody who could stand there who could say, okay, I will lend you the cash. You're going to have to pay me back in a week or a month or 6 months, but I can at least lend you the cash that you need short term to get you. And so that your customers are not absolutely terrified that you will not have the cash. I will give you the cash. I will lend you the cash. Okay? And that was the purpose of the Federal Reserve. And so that takes us to the 1930s. Okay? The 1930s was October 1929, a stock market crash. In October 1930, banks started failing. There were 256 of them that failed in November and 352 in December. And so there was this sort of domino effect of, one small bank got into trouble and others around it. And so banks started failing. And Friedman and Schwartz talk about a contagion of fear that spread among depositors, starting from the agricultural area. Okay. And so it was the Fed's responsibility, it was the Federal Reserve's responsibility to step in and lend to these banks and to stop these failures, to stop these 256 and 352. And the fact is, the Fed failed to act. Okay, they did not lend out the money. And this is, it goes under the term of high-powered money. These reserves that go to banks. And I talk about this much more in the class, both in my Harris class and in the monetary and the MPIF class. Okay. In 1933, 1/3 of the banks had failed. And this is just a picture to show that here we have the high-powered money. Yes, it increased a little, but look at 1929 through 31. High-powered money, the reserves that go to banks, this cash that is needed by banks when they start having a run, didn't increase at all. And I want you to keep this little table in mind. The banking system collapsed. The Fed had the power to create the high-powered money in 1929 through 31, but they did not do so. The banking system collapsed. The economy contracted by 1/3. This was an absolute economic disaster. Question is, why did the Fed fail to act? And that really is a critical question. The explanation, according to Friedman and Schwartz, is the shift of power within the Federal Reserve System. So this guy, Benjamin Strong, who was the president of the New York Fed, he died in October 1928, and it left a power vacuum. And so it was basically, I think, just there was neither the skill nor the knowledge at the Board of Governors in Washington. And so I think it was just a failure of governance and a failure of leadership within the Federal Reserve System. In any case, in the 1960s, Friedman and Schwartz came along, and up until their book, up until the 1960s, the view was that monetary policy had been very easy, and that the whole reason for the Great Depression was something other than monetary policy. Friedman and Schwartz came along, and they argued very persuasively that it was the Federal Reserve that caused the Great Depression. It was the Federal Reserve that made this bad, severe recession into the Great Depression. And the way the Fed did it was by failing to do their job, failing to provide the reserves and the high-powered money to the banks when they needed it. So they argued persuasively that money matters, and it matters dramatically during liquidity crisis, and that it was essentially the Federal Reserves were the ones who caused the Great Depression. So now let's fast forward to 2002. In 2002, there was a conference in Illinois. Illinois is one of the buildings at the University of Chicago. So this was at the University of Chicago, and it was to celebrate Friedman's 90th birthday. Friedman, and Schwartz, they both attended. They're both in their 90s, but they were both very active, very strong. Ben Bernanke, who was at the time a member of the Board of Governors, and he became chairman. He was chairman during the 2008 financial crisis. He gave one of the papers. He was discussing Friedman and Schwartz's analysis of the Great Contraction. And the end of his paper was just, I was in the audience for that conference. And I just remember sitting there, and the end of this paper by Bernanke was just amazing. Because what he said was, and this is Ben Bernanke talking, "Let me end my talk by abusing slightly my status as an official representative of the Federal Reserve. I would like to say to Milton and Anna, regarding the Great Depression, you're right. We did it. We're very sorry, but thanks to you, we won't do it again." That was in 2002. Now let's fast forward to 2008. Okay, because in 2008, Federal Reserve and Ben Bernanke, they did save the financial system. So let's go back to this table and remember that in 1929 to 31, this measure of high-powered money which are the reserves that go to banks. This increased by 0. It just did not. Federal Reserve did not distribute these reserves to banks. What happened in 2007 to 2009? Look at this. It just exploded. Okay? 69, 70% increase. This is unprecedented. This had never happened. Okay? It's never happened before 2008. So during the 2008 crisis, the Fed had learned, and they did the right thing. They massively increased this high-powered money. That's what went by the name of quantitative easing, QE1. This mainly went to bank reserves. It went to banks, giving banks the cash so that they would have cash if customers came and wanted their cash. Banks were panicked, and the Federal Reserve responded. Now, we can't say for sure what would have happened if the Fed had done something different. It's always a problem. It's the fundamental problem in economics. What would have happened? What is the counterfactual? We see what happened in the world. What would it have been if the Fed had acted differently? Okay, we can't say for sure, but 1907 and the 1930s, they give us a pretty good idea of what would have happened. Okay, in the 1907, we see this percent Y. This is how much output per person changed. Okay, down by 12.5. That's a big, huge recession. Look in 1929 to 33, down by 11%. That is a huge fall in output. This is a severe recession. In 2007 to 2009, yes, we had a recession here in the US, but not that serious. This is a picture of these reserves. This down here prior to 2008 looks like 0. It wasn't 0. It's just that this exploded so high that it makes the before look like 0. So I've ignored some things. The banking system in the 1990s, starting in the 1990s, changed. The reasons for the 2008 crisis were really not quite the same as 1907 and 1930s. In the fall of 2008, the Fed started. There's a bunch of issues. There's a number of details that I've glossed over, but the fundamental story is correct. Friedman and Schwartz, in their book, The Monetary History of the U.S., I think really did teach the Federal Reserve. They taught all of us. They taught economists, and they taught the world about the importance of money and the role of the Federal Reserve within the banking system. So that's pretty much what I want to finish up with. Is just this leads into a wider discussion in the history of financial crises. Okay, a whole set of issues. What is a bank? Why are banks subject to bank runs and crises? That's what I've tried to talk about today, just really briefly. But it also leads to money. What is money? How are banks and money connected? What is money? It's probably the most difficult question in economics. What about cryptocurrencies? Are cryptocurrencies currencies at all? What about inflation? What causes inflation? Current bout of inflation, right? 2022 saw a large increase in inflation, both in the US and worldwide. Friedman contributed to all of these topics, and these are the topics that I talk about in my course, History of Financial Crises, and it's the topics I talk about in MPIF. So that's what I want to finish on. I've talked today about their history, but with respect to Friedman, that's only one of his contributions. Okay, so Lingan, let me leave it there and let me stop sharing and turn it back.